You probably think that the money you have sitting in your bank account is totally safe. You probably believe that the FDIC is this magic shield that protects you from everything. But man, I have to tell you, there is a law that was passed back in 2010 that actually lets banks take your hard-earned deposits just to save their own skins. And the crazy part is that most folks in America, I'm talking the vast majority, have absolutely no clue that this law even exists. I really need you to get this. Like, truly understand what I'm saying right now. The cash that you think you have in your account, it isn't actually yours. Legally speaking, the exact second you hand that money over to the bank or do that mobile deposit, it becomes the bank's property. You stop being the owner and you become what they call an unsecured creditor. Basically, you are lending money to the bank and they are just promising to pay you back at some point. But most people, they don't know this. They think their checking account is like a personal safe or a lockbox. You know, money goes in, it just sits there waiting for you. You can grab it whenever you feel like it. But that is just not how the system works. Your deposit is legally a loan to the bank, and just like any loan you might give your brother-in-law, there is a risk you won't get it back. Let me start off with a little history lesson here because the stuff that is about to go down in America, well, it already happened in another country. And once you see how it played out over there, you are going to understand exactly why you need to move on this right now. So let's look at Cyprus in 2013. It's this small island nation in the Mediterranean, a member of the European Union, had a totally modern banking system, and everything looked just fine. And then, out of nowhere, one weekend in March, everything just changed. The banks in Cyprus were in deep trouble. They had made some really terrible investments. They were drowning in debt and were basically right on the edge of a total collapse. The government had to do something, and they had to do it fast. Now, in the past, when banks failed, governments would usually bail them out. They would use your tax money to save the banks. That is exactly what we saw happen in America back in 2008, right? We bailed out those big banks with hundreds of billions of dollars. But in Cyprus, they decided to try something different. They did this thing called a bail-in. Here is how it actually went down. On Friday, the banks were open just like normal. People were doing their thing. Then, over the weekend, the government announced these new rules. When the banks opened their doors on Tuesday, anyone who had more than 100,000 euros in their account was going to lose 47.5% of everything above that line. Let me just say that again so it sinks in. If you had 200,000 euros sitting in the bank on Friday, when you logged in on Tuesday, you only had 150,500 euros left. The bank just took 49,500 euros from you. They just took it. No warning, no choice, no negotiation at all. People were totally devastated. Life savings were just gone overnight. Businesses couldn't even make payroll. Retirees lost their nest eggs, and the wildest part is that it was completely legal. The government just passed a law over the weekend making it all legal. See, this is what a bail-in is. Instead of the government using taxpayer cash to save the banks save themselves by essentially seizing the depositors' money. Your deposits are used to recapitalize or fix the failed bank. Now, you might be sitting there thinking, okay, but that's Cyprus. That's some tiny little country. That could never happen here in the USA. And honestly, that is exactly what the people in Cyprus thought right before it happened to them. But here's what you really need to know. The legal framework, the laws for bail-ins, they already exist right here in the United States. It was created back in 2010 with the Dodd-Frank Act, and they have been refining it and expanding it ever since. So the Dodd-Frank Act was passed after that huge 2008 financial crisis. The goal, they said, was to prevent future bailouts. Congress was reacting to all that public anger about using taxpayer money to save fat cat bankers. So they came up with a new system. Instead of bailouts, we would have bail-ins. Instead of taxpayers paying to save failed banks, the bank's own creditors and depositors would pay. It was sold to us as making banks responsible for their own failures instead of forcing you, the taxpayer, to clean up the mess. Sounds pretty good in theory, doesn't it? Banks should pay for their own mistakes. But the problem is, when a bank fails, who are the creditors? You are. Your deposits are basically credits to the bank. You are an unsecured creditor, which means when the bank goes belly up, your money is used to save it. The specific mechanism they use is called the Orderly Liquidation Authority. It is right there in Title II of the Dodd-Frank Act. This gives the FDIC the power to just take over a failing bank and restructure it. And part of that restructuring can include taking your deposits and turning them into bank equity. What does that actually mean in plain English? It means they take your cash deposits and they hand you shares of stock in the failing bank instead. Your money just disappears from your account, and suddenly you become a shareholder in a bank that is collapsing. And here is the really sick part. They can do this without asking you. They don't need your permission. They don't need a judge to sign a court order. The FDIC has the authority to do this all on their own during a crisis. Now, sure, there are some protections. FDIC insurance covers up to $250,000 per depositor per bank. So if you have less than $250,000 in there, theoretically, you are safe. The FDIC will make you whole even if the bank goes under. But here's the thing they don't tell you. The FDIC insurance fund only has about $128 billion in it. But total bank deposits in the United States, that's over $18 trillion. You just have to do the math here. The FDIC fund covers less than 1% of total deposits. If we have a systemic banking crisis, like if a bunch of big banks fail at the same time, that FDIC fund is going to be completely empty almost immediately. There's nowhere near enough money to cover everyone's deposits. So what happens then? The FDIC has to go borrow money from the Treasury. The Treasury then has to either raise your taxes or just print money to give to the FDIC. Either way, you are looking at delays. You might be waiting weeks or even months to get your money back. And if they just print the money, inflation is going to destroy its value anyway. But more likely, they won't even try to use FDIC insurance for these massive failures. They will use bail-ins instead. It is faster. It doesn't require Congress to approve anything. It doesn't add to the national debt. It is literally the path of least resistance. And the legal authority to do it is already on the books. Let me paint a picture of how this would actually work in real life. Imagine it is the year 2026. The commercial real estate crisis has triggered failures all over the place. Regional banks are collapsing left and right. Panic is starting to spread. Depositors are rushing to get their money out. The FDIC steps in. They invoke that orderly liquidation authority I told you about. Over a single weekend, they restructure the failing banks. Large depositors, anyone with more than the FDIC limit, have their excess deposits converted into equity. The bank is essentially recapitalized with the depositor's own money. The bank reopens on Monday. You check your account. If you're lucky, you lost $150,000 overnight, and it is completely legal. You agreed to it when you opened your bank account. Buried deep in those terms and conditions that you never read is language that says the bank can do this in a crisis. Business accounts are especially vulnerable here. Most businesses have way more than $250,000 in their operating accounts for payroll, vendor payments, just keeping the lights on. They need that cash. A bail-in would absolutely destroy them overnight. Wealthy individuals are also at risk. If you have been responsible and saved your money, if you have more than the FDIC limit in your accounts, you are a target. Your excess deposits are considered available for a bail-in. Even retirement accounts might not be safe. IRAs and 401ks held at banks could potentially be subject to a bail-in. The rules are a bit unclear, but the legal authority is broad enough that it could include these accounts. Now, let me show you the proof that this is actually being planned. This isn't some conspiracy theory, okay? This is documented fact. In 2012, the FDIC and the Bank of England jointly published a paper titled Resolving Globally Active, Systemically Important Financial Institutions. This paper explicitly discusses using bail-ins as the main tool for dealing with failed banks. The paper states that bail-ins are better than bailouts because they don't put taxpayer money at risk. It outlines exactly how bail-ins would work in practice, and it recommends that all major countries adopt these bail-in frameworks. Then, in 2013, the Financial Stability Board, which is this international body of regulators, published guidelines recommending bail-ins as the standard approach for dealing with failed banks. The FSB includes people from the Federal Reserve, the Treasury, and other U.S. agencies. These aren't fringe documents. These are official policy papers from major regulatory bodies. They are openly discussing and planning for bail-ins. In 2015, the FDIC published its own guidance on bail-in procedures. They are required by law to have resolution plans ready for all the major banks. These plans detail exactly how they would restructure each bank in a crisis, and bail-ins are a core part of that. Every major bank in America has a living will on file with the FDIC. This document explains how the bank would be wound down if it failed, and these living wills all include bail-in provisions. This isn't hidden. It is not a secret. It is all public information, but nobody talks about it. The media doesn't cover it. Banks certainly don't advertise it, so most people have no idea this framework exists. But it does exist, and it will be used when the next crisis hits. Now, let me explain why 2026 is when this becomes real. Why is the timing so important? Because multiple crises are converging at once. The commercial real estate collapse is accelerating. Over $1 trillion in commercial real estate loans are coming due between now and 2026. These loans were made when interest rates were near zero and buildings were fully occupied. Now rates are triple what they were, and occupancy is down 30 to 50%. Property owners simply can't refinance at the new higher rates. The buildings aren't making enough money to pay the debt. Defaults are inevitable. And when the defaults happen, the regional banks holding these loans will face massive losses. We aren't talking about just one or two banks here. We are talking about dozens, maybe hundreds of regional banks that are heavily exposed to commercial real estate. These banks don't have enough capital to absorb the losses. They will fail. When Silicon Valley Bank failed in 2023, it happened in less than 48 hours. Depositors started pulling money out on Wednesday. By Friday, the bank was gone. $42 billion was withdrawn in just one day. The bank went from solvent to insolvent in hours. That was just one bank. Imagine that happening to 50 or 100 banks at the exact same time in 2026. The FDIC won't have time to arrange traditional takeovers. They won't have enough money in the insurance fund. They will have to use bail-ins. It is the only tool that works fast enough and doesn't require massive amounts of government money. The residential mortgage market is also a ticking time bomb. Millions of adjustable rate mortgages are resetting to much higher rates. Homeowners who could afford their payments at 3% interest can't afford them at 7%. Defaults are rising. Banks holding these mortgages will face losses. It might not be as bad as commercial real estate, but it is significant. This adds to the pressure on bank balance sheets. Credit card defaults are increasing. Auto loan defaults are rising. Student loan defaults are climbing. Every single category of consumer debt is showing stress. This means losses for the banks holding this debt, and the derivative exposure is massive. Banks are sitting on hundreds of billions in derivative contracts tied to interest rates and real estate values. When rates spike and property values crash, these derivatives will generate huge losses. We saw this in 2008, and it is happening again. And look, the FDIC knows all of this. They are watching the same data we are. They see the commercial real estate crisis building up. They see the consumer debt stress. They see the derivative exposure. They know a wave of bank failures is coming. That is why they have been quietly preparing bail-in procedures. They are getting ready to use this tool. They know they will need it soon. So, what do? How do you protect yourself from a bail-in? First, you need to understand your exposure. How much money do you actually have in bank accounts? Is it more than the FDIC limit of $250,000 per bank? If so, you are at risk of a bail-in for the excess amount. Don't think you're safe just because you are under the limit. The FDIC insurance fund is small. In a systemic crisis, there might not be enough money to cover everyone, even under the limit. And even if there is, you might wait weeks or months to get your money back. Second, spread your deposits across multiple banks. Don't keep everything in one institution. If you have $500,000, don't put it all in one bank. Put $250,000 in one bank and $250,000 in another. This keeps you under the FDIC limit at each institution and reduces your risk. Make sure the banks are actually different institutions. Having accounts at different branches of the same bank doesn't help you. The FDIC limit is per institution, not per branch. Third, consider moving money out of banks entirely. If you have significant cash, you might be better off holding it in Treasury bills directly. You can buy Treasury bills through Treasury Direct, the government's own website. These are backed by the full faith and credit of the U.S. government. They are safer than bank deposits. Treasury money market funds are another option. These funds invest exclusively in short-term government securities. They are available through any brokerage. They aren't bank deposits, so they aren't subject to a bail-in, and they are safer than keeping large amounts in a bank. Fourth, reduce the amount of cash you hold, period. Cash is vulnerable to both bail-ins and inflation. If you have more cash than you need for immediate expenses and an emergency fund, you should probably be in other assets. Gold and silver are physical assets that can't be bailed in. They aren't in the banking system. They aren't someone else's liability. You own them outright. In a banking crisis, precious metals hold their value while bank deposits are at risk. Real estate is another option. Property can't be seized in a bail-in. It is a real asset with intrinsic value. If you have excess cash sitting in a bank, using some of it to buy property reduces your bail-in risk. Stocks are also outside the banking system. If you own stocks in a brokerage account, they aren't subject to a bail-in. They aren't bank deposits. They aren't liabilities of the bank. They are separate assets. The key is to get money out of the banking system and into real assets or government securities that aren't vulnerable to a bail-in. Fifth, if you are a business owner, listen up, this is critical. You probably have significant operating cash in business accounts. This is extremely vulnerable to a bail-in. Sixth, be aware of the warning signs. When the bail-ins start happening, there will probably be some advanced indicators. Bank stocks will be crashing. Credit default swaps on banks will spike. News will report problems at specific institutions. When you see these warning signs, act fast. Move money out of vulnerable banks immediately. Don't wait to see what happens. Don't hope for the best. The Cyprus bail-in happened over a weekend. By the time people realized what was happening, it was too late. Speed matters in a banking crisis. The people who get their money out first are fine. The people who wait get caught in the bail-in. Seventh, understand that there might be restrictions. During a banking crisis, the government might impose capital controls. They might limit withdrawals. They might close banks temporarily. They might restrict transfers. This is why you need to act before the crisis, not during it. Once the crisis starts, your options will be limited. Cyprus imposed capital controls after the bail-in. People couldn't move money out of the country. Daily ATM withdrawal limits were imposed. It took months for things to return to normal. This could happen here. Eighth, don't assume your bank is safe. Even if your bank seems healthy today, that can change quickly. Silicon Valley Bank looked fine one day and was gone 3 days later. Banks can fail very fast in the modern financial system. And remember, in a systemic crisis, even healthy banks can get caught up in the panic. If depositors are pulling money out of multiple banks, fear spreads. Bank runs can happen at institutions that are actually solvent. The mere fear of failure can cause failure. Ninth, educate your family and business partners. Make sure everyone who has significant deposits understands the risk. Your spouse needs to know, your business partners need to know, your parents need to know if they have significant savings in banks. This isn't something to keep to yourself. The more people who understand bail-in risk, the more people who can protect themselves. 10th, monitor your accounts closely, check your balances regularly, make sure no unauthorized changes have occurred. In a crisis situation, mistakes happen. Money gets moved incorrectly. You want to catch any problems immediately. Now, let me address the objections. I know some of you are thinking, the government wouldn't let this happen. They wouldn't let banks take people's deposits. They already did in Cyprus, and they have set up the legal framework to do it here. The government's priority is financial system stability, not protecting your deposits. FDIC insurance will protect me. Maybe for amounts under $250,000 if the crisis isn't too big. If the FDIC fund doesn't run out, if you're willing to wait for your money. But that is a lot of ifs. And if you have more than the limit, you're definitely not protected from a bail-in. Well, my bank is too big to fail. That is what people thought in 2008. That is what people thought about Silicon Valley Bank. Banks fail, even big banks. And when they fail in a systemic crisis, bail-ins are how they will be handled. This is fear-mongering. No, this is reality. The legal framework exists. The policy papers are published. The historical precedent is there. Cyprus happened. This isn't speculation. This is documented fact. I don't have enough money to worry about this. If you have more than a few $1,000s in the bank, you should worry about this. Even if you are under the FDIC limit, delays in getting your money back during a crisis can cause serious problems. Not being able to access your cash for weeks could mean you can't pay rent, can't buy groceries, can't handle emergencies. Let me be very clear about something. I'm not saying to never use banks. Banks are necessary. You need checking accounts for daily transactions. You need business accounts to operate. I'm not suggesting you go completely bankless. What I am saying is, don't keep more in banks than you actually need. Don't treat your bank account as a long-term savings vehicle. Don't keep 6 months or a year's worth of expenses sitting in a checking account. Don't keep business reserves in your operating account. Keep what you need for immediate use in the bank. Put everything else in safer places. Treasury bills, money market funds, precious metals, real assets. This isn't radical. This is just prudent financial management given the risks we are facing. Now, let me paint you a picture of what the 2026 bail-in might actually look like. It is a Friday in late 2026. News breaks that a major regional bank is in trouble. They have announced massive losses on commercial real estate loans. Their stock is crashing. Depositors are getting nervous. By Friday afternoon, people are lining up at branches to withdraw cash. ATMs are running out of money. Online banking is overwhelmed. Social media is full of panic. Over the weekend, the FDIC steps in. They invoke emergency powers under Dodd-Frank. They announce the bank is being restructured. Trading is halted. Accounts are frozen. On Monday morning, the bank reopens. A press release announces the successful restructuring. The bank is now solvent. Crisis averted. But when depositors check their accounts, the amounts are different. Anyone with more than $250,000 has lost money. The excess has been converted to stock in the restructured bank. The stock is worth a fraction of the original deposit value. Business owners discover they can't make payroll. The money they thought was in their account is gone. They have been given worthless stock instead. Retirees who had their life savings and CDs at the bank find their principal has been partially seized. They were counting on that money to live on. Now it is gone. Panic spreads to other banks. Depositors at similar institutions rush to withdraw their money. More banks face runs, more failures, more bail-ins. The crisis spreads. The government tries to calm people down. They say the financial system is sound. They say deposits are protected. They say everything is under control. But people see what happened. They know deposits aren't safe. They know bail-ins are real. The trust is broken. This scenario isn't speculation. This is based on what happened in Cyprus and what the regulatory framework allows. This is what 2026 could look like. And here is the really disturbing part. Most people won't see it coming. They will have no warning. One day their money is there, the next day it is gone. Just like Cyprus, the people who will survive are the people who prepared. The people who understood the risk, the people who moved their money to safety before the crisis hit. So the question is, which group will you be in? Will you be someone who prepared and protected yourself? Or will you be someone who ignored the warnings and lost everything? The information is available. The legal framework is documented. The historical precedent exists. The warning signs are clear. You have no excuse for ignorance. You have no excuse for inaction. Let me also address the international dimension of this. Bail-ins aren't just an American thing. The G20 countries agreed in 2014 to adopt bail-in frameworks as the standard approach for dealing with failed banks globally. This means every major country has implemented or is implementing bail-in laws. Europe has them. Canada has them. Australia has them. If you think you can escape this by banking in another country, you are wrong. The same risk exists everywhere. The only real protection is to get money out of the banking system entirely and into assets that can't be bailed in. Physical gold, real estate, stocks, treasury securities, these are international. They aren't subject to bail-in regardless of which country you're in. Now, let me talk about the political dimension. Why won't politicians stop this? Why won't they protect depositors? Because the alternative is worse from their perspective. If they forbid bail-ins, then failed banks have to be bailed out with taxpayer money. After 2008, the public is violently opposed to bank bailouts. No politician wants to vote for using taxpayer money to save banks. Bail-ins solve this problem. Banks save themselves using depositor money instead of taxpayer money. It is politically easier, even though it is devastating to the people who lose their deposits. Also, most politicians don't understand the details. They passed Dodd-Frank without fully reading or understanding it. The bail-in provisions were buried in technical language. By the time anyone realizes what they voted for, it is too late. And frankly, many politicians keep their wealth in assets, not cash. They own stocks, real estate, businesses. They aren't vulnerable to bail-ins, so they don't see it as a personal threat. They are protected while ordinary people bear the risk. This is why you can't count on the political system to protect you. The incentives are all wrong. Politicians have reasons to allow bail-ins and no strong reason to prevent them. You are on your own. Your protection is your responsibility. The government will not save you from this. Let me give you a specific action plan for this week. Action 1, calculate your total bank deposits. Add up everything across all accounts. How much money do you have in the banking system? Write down the number. Action 2, identify your vulnerable accounts. Which accounts have more than $250,000? These are at immediate risk of a bail-in. Which accounts have enough money that losing access for weeks would cause serious problems? Action 3, open accounts at other institutions. If you have money concentrated in one bank, open accounts at one or two other banks. Spread your deposits so no single bank has more than $250,000 of your money. Action 4, open a Treasury Direct account. Go to Treasury Direct. Gov and set up an account. This lets you buy Treasury bills directly from the government. Start moving excess cash into T-bills instead of leaving it in banks. Action 5, open a brokerage account if you don't have one. Fidelity, Schwab, Vanguard, any major broker. Set up a Treasury money market fund. This gives you another option for parking cash outside the banking system. Action 6. If you own a business, audit your business accounts. How much operating cash do you really need? Move excess amounts to Treasury bills or money market funds. Keep only what you need for immediate operations in the bank. Action 7. Buy some physical gold or silver, even just a few ounces. Something tangible outside the financial system. This is insurance that can't be bailed in or frozen. Action 8. Talk to family members with significant deposits. Make sure they understand bail-in risk. Help them protect their money. Your parents especially might have significant savings at risk. Action 9, review your retirement accounts. Are they held at a bank or brokerage? If they are at a bank, consider moving them to a brokerage where they aren't subject to bail-in risk. Action 10, set up alerts on your accounts. Most banks let you set up text or email alerts for large transactions or balance changes. Turn these on so you're immediately notified of any unusual activity. Do these 10 things this week. Not next month, this week. The crisis is coming. You don't have unlimited time to prepare. Every week you delay is a week closer to the bail-ins. Every month you put this off is a month you're at risk. Now, let me be absolutely clear about the timeline. I don't know exactly when the bail-ins will start. Nobody knows the exact date. But based on the commercial real estate crisis, the bank balance sheet stress, and the timing of loan maturities, late 2026 or early 2027 is when things get critical. It gives you maybe 12 to 18 months to prepare. That isn't a long time, especially if you have significant assets to reorganize. Don't wait until the last minute. The people who get caught in bail-ins are the people who ignore the warnings. The people who thought it couldn't happen here. The people who trusted that someone would protect them. Don't be one of those people. Be someone who saw the risk and took action. Be someone who protected their family and their wealth. Be someone who was ready. If this video opened your eyes to the bail-in risk, share it with everyone you know. Your family needs to see this. Your friends need to understand this. Your business associates need to prepare. Help spread this information. Subscribe if you haven't already. I'm going to continue covering the banking crisis, the regulatory framework, and strategies for protecting your deposits. This is one of the most important financial risks we face. Leave a comment. Let me know if you were aware of bail-in laws. Tell me what you are doing to protect yourself. Are you moving money out of banks? I want to hear from you. Thanks for watching. Stay informed. Take action. And whatever you do, don't keep more money in banks than you can afford to lose.